When designing a tax, policymakers must decide how it will be structured. They need to take into account what type of tax is being imposed, what goal the tax is designed to achieve, and how the burden will be shared between taxpayers at different income levels. These questions help determine whether a tax will be progressive, proportional, or regressive. A progressive structure is one where wealthier individuals pay a higher percentage of their income in taxes than individuals at lower income levels pay. A progressive structure is typical of income tax codes. For example, an income tax could have a tax rate structure where those making between $0 and $10,000 per year have a 0% marginal rate, those making over $10,000 up to and including $100,000 have a 25% marginal rate, and those making over $100,000 have a 50% marginal rate. This ensures that as your income increases, so does your effective tax rate, with a maximum effective rate in this example of 50%, because that's the highest tax rate imposed in this tax code. If you don't understand what I mean by marginal and effective tax rates, take a few minutes to watch my video on tax brackets and marginal tax rates. A proportional tax structure is one where everyone pays the same percentage of their income, regardless of their income level. A sales tax is typically proportional. For example, a government could impose a 10% tax on all purchases. Wealthier people have larger disposable incomes, so they may spend more than those at lower income levels spend. Therefore, they may pay more in taxes, but their share of the tax burden is still the same. For example, if a person spends $10,000, he or she will pay $1,000 in sales tax. If another person spends $100, he or she will pay only $10 in sales tax. However, both individuals are still paying the 10% sales tax rate. Another example of a proportional tax would be an income tax code with only one tax rate. While sales taxes are considered proportional because they impose the same rate on everyone, some argue that they are actually regressive. I'll explain why after we cover regressive taxes. So as you can probably guess, a regressive tax is one where lower income people pay a higher percentage of their income in taxes than higher income people pay. Taxes that are measured in currency instead of percentages are examples of regressive tax structures. For example, consider a $2 tax on each pack of cigarettes purchased. A policymaker might impose a tax like this if they really wanted to discourage people from smoking. For someone who makes $10 an hour, this is 20% of their hourly wage. For someone making $20 an hour, it's 10%. For someone making $200 an hour, it's only 1%. So this tax is clearly regressive because it disproportionately burdens people with lower incomes. You may be able to see now why many people argue that sales taxes are regressive. There are certain items that are essential for modern-day living. These include food, water, clothes, light bulbs, and countless other necessities. For two equal-sized families, a certain base amount of essentials is required. Let's say these basic necessities together cost $10,000 per year, and the sales tax is 10%. This means that $1,000 must be paid in taxes. For a family earning $40,000 per year, this amounts to a 2.5% tax. For a family making $100,000 per year, it's only a 1% tax. For those who agree that sales taxes are regressive when the items subject to taxation include necessities, one way to make sales taxes truly proportional is to impose sales taxes only on non-essential goods and services. But this gets difficult because it's hard to define a non-essential good or service. What you regard as a fair tax is a matter of personal opinion. But whatever you decide, understanding the different ways a tax can be structured should make it easier to think critically about the taxes you currently pay and the taxes that policymakers may consider in the future. So that's progressive, proportional, and regressive tax structures. Thanks for watching.